The housing market is about to explode into a full-blown disaster. Millions of tenants have been piling up their debt during the current recession, and economists alert that as of January, with the expiration of the rental forbearance period, a gigantic wave of evictions, foreclosures and bankruptcies will trigger a chain reaction that could lead the real estate market to a crisis just as disastrous as the 2008 crash. Nobel Prize winner Robert Shiller affirms that the housing price bubble largely exceeds the stock market bubble, and things are about to get unsustainable pretty soon. Today, we are going to examine this chaotic situation of the housing market, according to experts' perspectives, and expose the many determinants that have been inflating this massive bubble. So stay with us, and don't forget to give this video a thumbs up. Share it with friends and subscribe to our channel to keep updated with the next unfoldings of the economic collapse. As soon as the year turns and the current administration expires at noon on January 20th, several cities will face a storm of evictions, foreclosures and bankruptcies as the housing bubble that has been massively inflating throughout the year will explode into a full-blown disaster. With tens of millions of Americans out of their jobs and unable to pay rent for the past several months, leaving building owners struggling to meet their mortgages payments, a new study by the non-profit Community Service Society, CSS, alerted that this situation will probably set off a chain reaction that could ultimately lead to a housing crisis comparable in scale to the 2008 crash. CSS President David Jones and Samuel Steen, a co-author of the report, joined Errol Lewis to explain that although the economic downturn consequent of the health crisis has been the trigger for this current situation, the bubble has been in the making for over a decade. They have been pleading to political leaders to address the approaching crisis without delay, stressing that it's urgent to take immediate measures to stop the bleeding. Some cities, such as New York, are now in a critical position since a staggering rate of rental delinquency was registered, and landlords have been eagerly waiting for the end of the forbearance period to solicit the issuance of eviction orders. Despite the popular slogans that were largely propagated by activists across the country asking landlords to cancel rent, rental payments cannot be nullified. That is to say, all the unpaid rent has continued to be accumulated throughout the crisis, which has also generated an enormous economic burden that will wreck many households when the bill comes due. In New York, Governor Cuomo announced a statewide moratorium on evictions back in March, which has been renewed 4 times, but the latest extension is scheduled to expire on New Year's Day. The governor defends that the measures were a necessary step to avoid having to displace families or end up enabling a calamitous homelessness crisis. However, according to the CSS report, the challenges facing families extend to their building owners, whose mortgage default highly enhanced the housing market bubble, providing that federal aid has disappeared months ago, and since then, neither renters nor owners could bear to afford the entire amount of their debt. On many occasions, real estate firms entered 2020 leveraged to the maximum, demanding forever higher rents and then borrowing against the value of those income streams. As real estate markets soared in several cities across the state, landlords raised rents, resold their buildings at higher prices, and used their properties' rising values to take out ever larger mortgages, the report describes. These strategies attracted huge amounts of money to the business of owning rental buildings. They also left those same buildings and their tenants vulnerable to market shocks because they were dependent on 2 assumed constants: ever-rising property values and rent payments. If this description sounds like something you've heard before, it's because you did. The report also recalls that from the mid-1990s up to the 2008 mortgage crisis, real estate firms started an irrational rush of buying and selling buildings and consistently raising rental prices. The average cost of rental properties hiked by almost 400% in 4 of the 5 New York boroughs, with Staten Island as the only exception. CSS says, in every step of this impetuous path, whenever the value of buildings increased, real estate firms kept taking out loans against the new, higher value. Oftentimes, the extra money was directed to the purchase of additional buildings. Consequently, the whole housing market collapsed in the famous 2008 crash, after banks went under, and as a result, credit ran dry, leaving several real estate firms in huge debt and unable to meet their mortgage payments. However, that didn't stop a new wave of investors who emerged scooping out the defaulted mortgages and buildings for pennies on the dollar. Of course, when the market recovered, their profits skyrocketed. But for renters, the situation became increasingly deteriorating. Many of these buildings were subjected to disconcerting changes of ownership, frequently being neglected and having low to none building maintenance and services. And considering rental properties are usually structured as limited liability corporations, the bankruptcy of one building alone doesn't pose a harsh impact on the finances of the real estate parent company. In short, as the New York Daily News explained, for the firms involved, the market boom and bust can be like a game of Monopoly. But for renters, it can be the difference between having a safe home and being homeless. Keeping in mind that for the past decade, such firms have been repeating the same misconduct, all of this could happen again next year. As low-income tenants are suffering throughout this economic and public health crisis, major investors are gathering billions of dollars to buy up buildings and extract maximum profits, outlined CSS housing analyst Samuel Steen, who's also one of the report's co-authors. New York faces a stark choice. Will we let this happen, or will we take bold actions to secure a better future? That doesn't mean that capitalizing in the real estate market is a despicable investor attitude. But allowing the formation of a colossal wave of foreclosures at the expense of entire cities' economies just to ensure predatory investments could come at a high cost to the whole nation, warned CSS President David Jones. Policymakers need to heed the housing movement's call to take action now and interrupt the coming frenzy of real estate investment that will only lead to further instability for tenants and more people joining the ranks of the homeless. Now about 60,000 in New York City alone, because we're marred in policies that treat housing as a commodity, Jones told local news. One solution he proposes for New York is to intensify its commitment to what is known as social housing. Arrangements like limited equity cooperatives and tenant interim lease buildings, both of which give tenants more control of what happens with the buildings they live in. Jones also supports the creation of a nationwide legislation that would give non-profits interested in these buildings the first crack to the purchase, averting their foreclosure and preventing private firms from taking ownership of these properties solely to boost their profits. However, this is a very expensive idea, and amid a decaying economy, it's very unlikely that there will be a quick enough federal response to assess this matter in the coming months. Additionally, for homeowners, the outlook doesn't look any rosier. Today, there are fewer homes for sale in the US than ever documented in roughly 40 years, when data started to be recorded. For this reason, it's understandable why home prices are going up much faster than incomes, making home ownership less affordable for more and more Americans. We are simply facing a housing shortage, a major housing shortage, expressed Lawrence Yun, the chief economist at the National Association of Realtors, which tracks home sales. We need to build more homes. Supply is critical in the current environment. Last Thursday, the Realtors Group reported that the average price for previously owned homes has hit a new record at $313,000, a 16% increase compared to the same period last year. But many other factors are at stake. Ever since the health crisis burst and prompted the home office trend, along with remote schooling, many families are buying bigger homes. According to the NAR, the supply of previously owned single-family homes fell to 2.4 months in October, the lowest since 1982, when the association began collecting the data. At a time of record low interest rates, it was already expected that buyers would want to take advantage of the opportunity brought by the Federal Reserve money-injecting policies. But the market got trapped into a very common economic dilemma. The lack of supply is progressively elevating prices, especially considering the acute spike in demand. Housing inventory shortages have pushed national home prices considerably higher, says Joel Kahn, Vice President of Economic Forecasting for the Mortgage Bankers Association. We have been underproducing for the past decade. We need more construction, Jan advises. After the 2008 housing crash, a lot of smaller family-owned home builders went out of business. Together, those small businesses built hundreds of thousands of homes, says Jan. And now that they're gone, the real estate market has been coping with an anemic home building. There are other pressing difficulties as well. After the tragic wildfires in the western US, supply shortages in building materials pushed the prices of items such as lumber for framing houses to double during the current recession, even though prices have been coming down from their peaks. Builders cite a lack of lots and decreased availability of building materials as headwinds that will limit production, stated Robert Dietz, chief economist of the National Association of Home Builders. Jan argues that in order to ease the burden of the housing crisis, the country needs to build millions more homes, both single-family houses and condos, which also would help to heal the inflammation of the labour market, since it would create a lot of jobs. On a similar note, in a recent article, investment advisor for Sika Pacific Capital Management, Mike Mish Shedlock, illustrated how home prices are in a bubble that is even bigger than the stock market bubble. On the basis of Yale University professor and Nobel laureate Robert Shiller's evaluation, Mish explains why, although stocks are overvalued considering historical measures, it's nothing compared to skyrocketing home values. Consider the Case-Shiller National Home Price Index has gained in excess of 6% per year on average since January 2012, while net rental income has barely kept up with inflation, increasing just less than 2% per year. The result is that home prices seem as overvalued as they were in the spring of 2005, 9 months before the peak. Mish describes, a form of measuring home valuations is with a cyclically adjusted price to earnings, or CAPE, ratio, developed by Shiller for stocks. The logic can be applied to a broad range of assets by dividing the prevailing price of an asset by the average annual inflation-adjusted earnings over the prior 10 years. As the chart illustrates, the fluctuation of CAPE for US home prices and the S&P 500 index since 1996, showing how house prices dramatically soared over the last decade. Furthermore, the expert points out that to make it worse, all previous history came at higher mortgage rates. The median 30-year fixed mortgage rate has dropped below 3% for the first time in August 2020, and rates are near the lowest possible levels considering the credit risk and costs of writing mortgages. It's one thing to be a peak valuation, it's another to be at peak valuation with no discernible upside. He says, presenting the following chart where he looks at household income versus the Case-Shiller Home Price Index. And as we can observe, average household income went up approximately 64%, while home prices were up by a staggering 118%. Robert Shiller calls it a bubble, and so do I, Mish concludes. Basically, everywhere one can look inside the housing markets, ravaging signs indicate the coming of a catastrophic burst. It's literally just a matter of time.